So Oxford Economics just put out this report that the Canadian housing market isn't going to be affordable until 2035. So I'm just going to go over their model for basically why they're saying what they're saying here. And let's start by diving into this article. So Canadian mortgage rates to rise, housing unaffordable until 2035, Oxford Economics says. So good news. Canada prevented the mortgage cliff that would have seen existing borrowers pay more. The bad news, the rapid rate cuts and extended amortizations are only expected to help new buyers for a few weeks before further affordability erosion. That was the take in a new report from Oxford Economics, who doesn't see affordability returning until 2035. The fuel being added to the fire means mortgages aren't expected to get much cheaper, with borrowing costs forecast to start climbing in 2026. That's good news for the economy, but not so much for those looking for housing affordability improvements that last longer than the election cycle. So here they have their model basically graphed out. Canadian housing affordability won't return until 2035, even later in Toronto and Vancouver. So as you can see, as per basically what this article is alluding to, is you can see real estate here getting more affordable, hitting a bottom, and then getting less affordable into 2026, 2027, partially 2028, before it starts getting more affordable again, taking us into 2035 before it's deemed back into the range of, being acceptable, I guess, right? So how is this even possible, right? Well, everybody thinks that housing affordability is all about prices. It's not. There are many variables in that equation. There's wages, interest rates, and then the price, right? So when it comes to housing affordability, real estate can actually get more affordable while the price is increasing. Now, that's not what they're saying is going to happen here. Essentially, it's going to get more unaffordable right here would be that jump upwards as they say prices are likely going to go up, right? But how this happens is, let's just say the price of real estate trades flat until 2035. Well, if Canadian median wages are increasing during this time, like if wages are going up 4% per year while the price is staying flat, well, real estate gets 4% more affordable every single year, right? That's how that happens. So when people are like, oh, real estate needs to be more affordable, they're always alluding to the price. They don't realize that there's interest rates and wages in that equation as well, and that real estate can actually get more affordable while the price remains flat or stays the same, right? Falling mortgage rates and 30-year amortizations are expected to boost affordability early next year. So that's this part of the graph, right? The impact will be short-lived since the excess leverage will help to raise home prices. As home prices rise, mortgage rates will start to rise, and that affordability boost will be expected to fade. So what they're talking about here is, like, recently I just did a video on this. They are increasing amortizations of the insured mortgages from 25 years to 30 years. That equates to an additional $50,000 to $60,000 in purchasing power. Spoke to one of my brokers. That's basically what he said to me. But not only that, now the down payment for a $1.5 million home is $125,000 when it used to be $300,000. So in my most recent video, if you're buying a $1.1 million detached home, you only need $85,000 down. And then if that detached home has a suite and you can rent that suite for $2,000, well, your mortgage payment is literally going to be like less than $3,000 to buy a detached house with less than $85,000. So I tend to agree with this. Yeah, I think there will be a short-term boost in housing prices throughout the spring. And then who knows, maybe they stop cutting rates. Maybe the bond market starts to rally again. And that's kind of what they're predicting here. But regardless, people that are hoping for home prices to just crash in the next 6 months, with all of the, essentially stimulus is what it is, with these new regulations that help home buyers be able to afford more home, with all these regulations and interest rates dropping, it's going to be very difficult for prices to drop in the next little bit. Slower population growth is expected to help slow rising prices, but affordability will take a long time to return. We still think it will take around a decade to restore housing affordability at the national level, explains the report. And just to show you guys something, so average hourly wages among employees actually increased 4.1% on a year-over-year basis in November. So that means since last November, wages have gone up 4%. So if the price of homes stays flat, well, real estate actually got 4% more affordable this year, even though the price is exactly the same, right? The epic combination of cheap credit, bailouts, and increased leverage will take its toll for some time. Their forecast sees affordability returning by 2035 for Canada in general. More expensive cities like Toronto and Vancouver are forecast to stay out of reach indefinitely for the average household. I actually highlighted this in another article here, right? Out of reach for average buyers. I have been saying this for 3 years. People always get pissed at me when I say this. Vancouver and Toronto are above average cities. Therefore, it would make sense that unless you have an above average income or amount of wealth, that you wouldn't be able to afford to buy in these cities, right? If it was easy and everybody could do it, then you get what I'm saying? Like, it just doesn't make sense, right? Obviously, most of the people in Canada would probably prefer to live in Vancouver. The price of real estate here is what weeds out some of that demand and makes it so the people who can afford to live here end up buying here, and that's how you keep the supply and demand in check and making sense. That's how you keep it in balance, right? So completely agree with this. It makes sense that, the average buyer wouldn't be able to afford a home in Vancouver and Toronto unless they're getting some kind of help from their parents with a down payment, grandparents, something like that, right? Bank of Canada cut rates, but fixed rate mortgages already lower. The economists see further rate cuts from Bank of Canada, but it won't be helping new borrowers. The aggressive 50 basis point cut to the overnight lending rate in October is expected to almost eliminate the concerns of a rate renewal cliff. The firm's economists expect another cut of 50 bips in December and 4 more 25 bips in the first half of the year. When it all shakes out, the overnight rate is expected to fall to 2.25% by June 2025. It's a substantial move, but it only impacts the relatively small share of variable rate borrowers. The BOC's overnight rate only directly influences the variable rate mortgages. Fixed rate mortgages are influenced by Government of Canada bond yields. Currently, fixed rate mortgages are significantly lower than variable mortgages, so the cuts won't be contributing much more credit capacity than already available in the short term. Additionally, real estate activity from further rate cuts would be largely based on sentiment. So basically right now, I think you're getting a variable somewhere right under 5. Or 5.25. There's like a 0.75 spread. So variable rate mortgages won't be what fixed rate mortgages are until probably March, like another 0.5 and then another 2.25% decrease. But again, that's only 3 months away. So the bond market kind of has bottomed in the short term. Although, actually, you know what? I think it just recently took another leg lower. Let me take a look at this. Canada 5-year. Yeah, so we're back at 2.8 again. Yeah, look at this. So we were all the way up at 3.3 October 21st, and we have tanked all the way back down to 2.8. So I'm assuming banks would probably adjust their rates to reflect this sometime soon. And back when we were kind of around this range, like 2.8, 2.75, you could get fixed rates under 4. So, I mean, you're probably getting fixed pretty soon here in the low 4s again. So basically the point of this article is, if you're hoping for home prices to go down 50% to make real estate more affordable right now, that doesn't have to happen. Real estate can just trade sideways for, the next decade, and then it would happen. And that's kind of what we saw in the 90s, right? So, I mean, if wages increase 4% every year and we are 40% more unaffordable than the historical mean, well, in 10 years we would now be within that mean of historical affordability. And just looking at this chart, it looks like these are basically in conjunction with rate cuts, stimulation, new regulations, and then once we get down to that 2.25%, kind of in the back end of 2025, you might see maybe bond yields or possibly interest rates going back up. And that's why it gets less affordable in conjunction with, possibly even higher real estate prices. Like I've been talking about how I think detached homes bottomed a while back, and I think detached homes are only going to pretty much go up from here. I think that's basically what this chart is kind of graphing out in real time for us. If you thought this was an interesting video, please subscribe. I have a newsletter where I go over market insights and handpicked deals. You can join using the link below. I'm that Agent Kelly. Give me a ring if you want to buy or sell. I'm making moves to move you. Peace.